I decided to buy Adobe stock, and let me tell you why. As you can see, today they're up about 0.58%, which is about $2, and the overall stock price is $382. But if we take a look at the year-to-date chart, they're down 13%, and the year chart, they're down about 27%. Now, currently Adobe has a market cap of 162 billion, and they have a PE ratio of 24.47, and Adobe is considered to be a growth stock, so this type of PE ratio for a company like this is very intriguing to me. Now, if we take a look at how profitable this company is, we can see that the profit margin is 30.39%, which is huge for such a huge company, and an operating margin of 35.91%. When a company this big has this kind of numbers in terms of profit, it usually means one thing, and that is that they have a lot of moat. And that is actually one of the reasons why the stock is falling in price, because of the whole AI thing that's going on. People think that it's gonna disrupt or hurt Adobe's numbers, when in the case, yes, it does make sense. There's AI now. You could type, hey, build me a picture of this and that, and then a website will build it for you, which is what AI is used for, to make videos. You can make your YouTube thumbnails, you could graphic design. But I think if the technology is out there, such as AI, Adobe is most likely going to incorporate it in their system, and they're just going to keep growing. At least that's what I think, and that's why I decided to invest in this company. Their return on asset is 17%, and the return on equity is 52.25%. I mean, their revenue, 22 billion. If we take a look at the balance sheet, they have 5.71 billion in total cash, and if we take a look at the overall company debt, it's 6.56. That means they have a current ratio of 0.99. They could pay their debt with their on-hand cash just like this. Okay, now although their intrinsic value doesn't state that it would be a good idea to buy this company now, except in the original Graham formula, which you would have about a 10% upside. But as you know, and if you've been watching the channel, I like to buy my stocks with a margin of safety of at least 35%, and that means I will be buying this stock at $244. But typically with growth stocks like this and how the market currently is behaving, it's very hard to predict or follow this formula when buying stocks. However, it does give you a pretty good idea. And even if we buy it now, I mean, the stock is considered to be around the $400 to $376 mark. But if we do take at another intrinsic value, which is the discounted value, you can see that the relative value is between $375 and $562, which is in the base case. The best case, the company will be worth around 613 to 607, and yes, the worst case, the company will be overvalued by 1% over here. But if we take a look at the discounted cash flow plus the relative value, the company could be worth about $503, so there's still some upside from here. And if you take a look at the annual financials for this company, I mean, everything's up: net income, operating income, revenue, EPS, operating cash flow, and free cash flow. And once again, if we take a look at the current assets versus the liabilities, which is something similar to how much cash they have compared to their debt. Assets pretty much is something that's bringing in revenue. They have almost double their assets of what they have in liabilities, which is very good for a company. And one last thing to take note of, why I mentioned that sometimes it's hard to do the intrinsic value of growth companies like this. If we take a look at the history of the stock price compared to the EPS, earnings per share, compared to the PE ratio, we can see, like, for example, here in 2021, they had a PE ratio of 66. The stock price was 695, and they only had EPS of $10 per share. Fast forward to today, the stock price is about 380 bucks. The PE ratio is 24.38, and their earnings is going to be somewhere around the 15 mark. So you're paying less for the company. The company is at a cheaper price than it was in 2022, and the company is making more sales than in 2022. I mean, to me, this kind of makes sense to buy such a company like this. Obviously, I'm not a financial advisor, right? Do your own due diligence. I did invest in this stock before when it was around the $340 mark, I believe, but I decided to sell it because it went up really quick after what happened in April 4th. And as I mentioned before, I don't like holding stocks after they go up like 10-15% in a week. It just doesn't make any sense for me. I'd rather take my profit. And unfortunately, it doesn't work all the time. That's why you should stay in the market and not try to beat the market. It happened to me with ASML. I had ASML at like 680 bucks. I sold it at 700 or something, and now it's at like $800, but it happens. I did miss out on Adobe as well. It was upwards of $400, and now I'm getting another opportunity, so I am not gonna miss it. And another thing is, they're not diluting their investors. As you can see, the shares issued, it's maintained the same. Yes, they're not having less, they're not buying back shares yet, but it's maintaining the same. And I think at these prices, once management start buying back their stock, I'm going to invest a lot more in this company. But for now, I'm going to have a small position. If you enjoyed the video, please consider leaving a like. Don't forget to subscribe. And as always, I'll see you on the next video.